After the sell-off yesterday, will markets keep their rally today? That's coming up on 3 Minutes on Markets and Money. One thing you have to be careful of in trading your portfolio is what's happening in the headlines. Headlines are almost always wrong about what's actually happening in the markets. And despite yesterday's headlines that it was the rise of the Omicron variant and, of course, the failure of the BBB plan to pass, that's what led to the sell-off yesterday. Not really. This has been a decline over the last 3 days that, again, really works within this time of season where we're having mutual fund distributions, tax loss selling, etc. And if you take a look at what's been happening in the markets, it's not been a function of inflation versus deflation trades. Yesterday, tech stocks were selling off, and it was because of inflationary pressures. This morning, stocks are set to rally out of the open, and inflationary stocks are leading the way. Technology stocks are going to be opening up much sharper than the S&P. That all suggests that a lot of this has been tax loss selling, rebalancing, capital gains distribution by mutual funds. And now as we head into the last part of the year, potentially start seeing those allocations being put back onto books. We'll see what happens. Yesterday, the markets did wind up opening substantially lower, actually sold off about 2% yesterday and wound up holding the September highs for the market as well as those November lows, rebounded off of that and actually closed above where stocks opened yesterday. So that was actually some bullish buying all day. Starting to see some stocks being put back onto books. This morning, stocks are looking to open higher. The first challenge, of course, is going to be that 50-day moving average, and that's going to provide some level of resistance here. I don't think we get above that today. We could see a bit of action here, but if the market does build today and get back above that 50-day moving average, that's going to put the markets in line with potentially retesting highs by the end of the year. Now, as we said earlier in the month, we suspected then and still suspect now that the previous highs, which now are multiple tops, are going to be probably all we see this year, particularly if we do get that traditional Santa Claus rally. If we do manage to break out of those highs, that'll probably be in January and would suggest a little bit further advance at that point. But we are building this very strong resistance level at those previous highs and those previous tops. So again, do pay some attention to that risk in portfolios as you start to look at this recovery in the markets, potentially if we get it. This is going to be an opportunity to rebalance risk. If you've had a lot of stocks in your portfolio lately that have been hurt a lot more than the market, you're probably getting a little bit too much risk in your portfolio. Might want to think about rebalancing those, looking to build into your portfolio as we move into next year, where we're going to have slower monetary inflows, potentially higher interest rates, more inflationary pressures, etc. A lot of those tailwinds that are now becoming headwinds as we move into 2022. Start thinking about a rotation towards value over growth, more fundamentally strong companies versus a lot of the companies you may own that have very weak revenue, low sales growth, and no earnings in a lot of cases. So again, a lot of those meme stocks have been losing a lot of ground lately. May see some bounce in those. Those are going to be opportunities to sell those stocks and start to look to rotate into more fundamental quality stocks as we move into 2022. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.